Hello, everyone. Thank you for joining us today. This is Michael Kupfer with Harvard Business Services, and our webinar today is Making Changes to Your Delaware Company. I am joined today by our two speakers for this presentation, Brett Melson and Jarrod Melson. No coincidence that they have the same last name. They are, in fact, brothers, both working for us here at Harvard Business Services. So we're excited to have them lead our discussion today. And just a couple quick announcements before we get started. The first being that we are recording the webinar today, so the recording will be available for your viewing starting tomorrow, and you can watch it anytime at your leisure if you want to go back and catch something that you might have missed. We'll also be distributing the slides that we're using today as a PDF, so you can look through those as well whenever you need to. We do welcome your questions during this presentation, so if you have any questions about the things that you're hearing or something related that we're not covering, feel free to chat it in. We might be able to take some during the discussion, and anything that we don't, we will answer at the end. So don't be shy, just type in any questions that you might have. And before I turn things over to Brett and Jarrod, I just want to give a little bit of information about us as a company. We are Harvard Business Services. We're a family-owned company that was founded in 1981. We're headquartered here in Lewis, Delaware, right on the Atlantic coast. We're a formation agent for more than 200,000 companies worldwide. That number is, as of just this past month, we hit 200,000. And we are a Delaware registered agent. And we're rated 4.9 out of 5 by our customers on Trustpilot.com, which is a third-party reviews platform. We're very proud of the feedback that we get from our clients, so we do invite you to check that out if you want to see what people are saying about us. It is important to note that we are not lawyers or accountants as a company, and we're not affiliated with Harvard University. None of the information that we're going to give you today should be taken as legal or accounting advice. So with that being said, here's a list of some of the common questions we get asked about changing companies, and these are the things that I'm going to ask Brett and Jarrod to cover for us today and help you understand the process for these. So Brett, would you like to jump in?
Hello, everyone. Thank you for attending. We're excited to be able to present this to you. We're going to go ahead and kick it off with how to change your Delaware company name. Changing the name of a Delaware company is a very straightforward process. We're going to go ahead and check the name of the company to make sure it's available. We're going to prepare a certificate of amendment, and that's filed with the State of Delaware. You know, it's quite interesting. You know, right here on the right-hand side, we have an example of one that's quite comical. We have Brad's Drink. That was the original name of Pepsi. Pepsi then changed their name. So it's not uncommon for a client to go ahead and originally choose a name that no longer suits the needs of the business. So like we always say, changes can be made to the name, the stock, the sky's the limit.
I think, Brett, it's important before we move on just to note that reserving the name or checking the availability of the name with Delaware is not the same as in any way trademarking, copywriting, or otherwise protecting any intellectual property. And also, it is not checking a name for any purpose outside of the state of Delaware's availability. So, for instance, website availability. Often, you know, a client or a company could have a name, get it checked in Delaware, but then find out someone has a trademark, or for instance, the website using that name is taken.
Yeah, that's a great point. So we're checking this name against Delaware Division of Corporations and their database only. And if it's available, we're able to move forward with that amendment. So this amendment's just one filing with the state. It's traditionally just a one-page document that's submitted to Delaware. The certificate of amendment notifies the state of your current name and then the new name that you wish to use. If this is filed through a registered agent such as ourselves, we traditionally have this back stamped, approved from the state of Delaware in about 3 to 5 business days, and we're able to email you that document. Once this is complete, it is imperative to write down anybody and everybody that concerns the business. You'll want to notify them that this name has in fact changed. You'll want to make sure you notify the IRS, vendors, banks, partners, anybody and everybody that you do business with. And most importantly, it's a great idea to make sure you notify your customers. That way, when checks start coming in, they're coming into the correct name of the company.
Now, Brett, while we're on the topic of names, I know there are certain limitations Delaware puts on names, no vulgar terms and whatnot, but with medical and recreational cannabis being as popular as it is as a new business entity, what general restrictions are there with any use of drug-related terms?
Delaware traditionally is not going to allow the use of names that have marijuana in the name. If there are names that do somewhat seem like they may be dealing with marijuana, the state may come back and ask for a purpose. They're really looking to make sure that there's no THC involved. So if you're dealing with, for say, CBD oil, which doesn't have any sort of THC, that's what Delaware wants to know. Hey, we're dealing with a CBD oil product. This 420 Creations Inc. that we're wanting to move forward with will strictly deal in CBD and will not have any THC. And as long as there's no THC involved, the state of Delaware is typically A-OK with that. The state of Delaware will not allow us to use words in a company name, such as bank or any variation of the word bank.
That is, unless you're actually registered as a bank.
That's 100% correct. So even words such as BANC, non-U.S. words of bank, the state of Delaware will not let us move forward with. The next topic that we're on to is how to change your business address. If you're moving the location of your business, you're going to want to let parties know of the change. One of the most important government agencies to notify is the IRS. Clients are going to report this change using Form 8822B. So this is changing the address or also changing information of the responsible party that the IRS has on file. This form is going to notify the IRS of the change and any change to the contact information for the EIN's responsible party that they have on file. So this responsible party, it's going to be someone with control over the business entity by virtue of a title, position, or through ownership. Is there anything you'd like to add on that, Jarrod?
That's right, Brett. It generally has to be someone with control over the entity, as you said, title, position, or ownership. While you don't have to supply any member or owner information to the state of Delaware, or even to us as registered agent, this is a way in which the IRS does obtain a certain level of ownership information or control information.
Thank you. So it's also important to make sure you notify your registered agent of this change. One of the main functions of the registered agent is to accept any service of process, lawsuits served on the company, or notices from the Division of Corporations. So these notices and these service of process, we need to make sure they're going to the correct address and the correct information on file. You're also going to want to make sure you update the banks, the partners, vendors, and anyone else that you work with as well. And most importantly, don't forget your customers. Make sure those checks are mailed to the correct address.
And I want to reiterate that point simply and also state that any contract a business has, you really need to look at that agreement and modify the address on file there. Most contracts provide a designated address for notices, and notices are only effective when provided to that address by certain means. And the counterparty is able to rely on the accuracy of that address and the fact that you're receiving those notices until they receive notice otherwise.
Fantastic. So now we're on to how to change your Delaware registered agent. So you may not be satisfied with the current registered agent. They may have promised you a fee to begin with, and next thing you know, the fee's up over $200. They just simply might not be providing to you the level of service that you think they should be. Well, Delaware allows you to go ahead and change the agent very quickly. This filing takes about 3 to 5 business days. It's key to make sure that you find a registered agent that's been in existence for a while. With Harbor Business Services, our annual agent fee is $50 a year, guaranteed, never to go up for the life of the company. It's been fixed since 1981, and we offer stellar customer service, so you know exactly what you're getting. With this change, traditionally the registered agent's going to go ahead and prepare the document to change the agent. They're going to go ahead and email that to you for signature. The agent makes the filing with the Division of Corporations to go ahead and enact the change. In about the 3 to 5 business days, Delaware is going to go ahead and stamp that document and return it, and the agent in turn will go ahead and email you that document. That's the evidence showing that the agent has been officially changed. It's also a good idea to send a copy of that stamped document to the current registered agent. Even though they're notified through the State of Delaware's computer system, it's not uncommon for them to continue to bill you until they receive that notice. So now we're off to a very interesting topic, is converting a Delaware LLC to a Delaware corporation. So let's go ahead and start with, why would somebody want to go ahead and convert their company? Jarrod, this is really in your wheelhouse.
Thank you, Brad. There's a number of reasons why someone might want to convert to an LLC, from an LLC to a corporation. The LLC is an extremely flexible business entity. It allows you to do a lot of things that a corporation can't, simply because a corporation is bound by certain rules that can't be waived or modified or bent beyond certain points. In an LLC, of course, you have complete freedom of contract within the bounds of good faith to design your own terms. So a lot of times people would say, well, why would I move from freedom of contract to something more rigid? And the reason oftentimes is that professional investors, sophisticated investors like venture capitalists and venture capital funds, simply won't invest in a Delaware LLC because it has pass-through tax treatment as its default. Generally, this means that the entity itself is not taxed, but the members have to take in consideration in their taxes their distributive share of the gains and losses, the profit and loss of the company. That becomes a nightmare for these sophisticated investors, essentially being the entity standing behind an LLC. Now, you could elect corporate taxation with an LLC, but even still, a venture capitalist also will want to know that it has the predictability and at least the protections of corporate law. There's a lot of ambiguity in drafting your own LLC agreement, and the default rules of Delaware corporate law give them some comfort and predictability. They're accustomed to it, and they know what's involved.
So with the corporation that we'd be converting to, these 3 tiers of power, the officers, the directors, the shareholders, you mentioned these rigid type formalities. Why would they want to go ahead and go to this type of structure? Would it be for those rigid formalities, or would it also be for, say, the ability to go ahead and issue stock to the investors? The shareholders now know exactly what to expect from a Delaware corporation?
Yeah. Well, there's a number of reasons you might do that. First, of course, the tax treatment. If you need entity taxation, if you want to be taxed as a C corporation, which is effectively means a corporation taxed as an entity as opposed to a pass-through like an S corporation. So first, the tax treatment is one reason you might want to be a corporation. Secondly, shareholders are often more comfortable with a corporation because there are those limits to what can be waived. And a lot of the things that are ordinarily waived by management are the duties that they owe shareholders. In an LLC, you can entirely eliminate fiduciary duties. However, in a corporation, there are times you can remove a director from, you can exculpate, as they say, a director from liability for certain breaches of duties, but the corporation is still liable. He still owes those duties to the shareholders. So a lot of times the rigid formulations give shareholders a comfort that there's at least bedrock they're standing on. In addition, and lastly, I think, is an LLC, when you're drafting your own language, it becomes very ambiguous. A judge or even attorneys looking at a corporate document generally know what they're looking at. They know what the terms mean, what the formulations are, and they're terms of art. However, in an LLC, you can essentially draft anything you want, and no one particularly knows what was intended by specific words, phrases, and provisions. So it's a matter of predictability, really, in a lot of ways.
Interesting. So Delaware does make this conversion filing somewhat simple, somewhat quick. It just needs to be done properly. To complete the conversion, you'll need to know how many shares of stock that the entity will need to have. The stock is what's going to show the ownership in the company. And we'll need to know if it's going to have, 1,500 shares, if it's going to have 1 million shares, if it's going to have 10 million shares. And that really brings into play what you expect down the road from this company. Is it going to be bringing aboard investors? What's the ultimate goal? One thing to consider is the Delaware franchise tax. When switching to a corporation, there are fees paid for the right of privilege to have a Delaware corporation, and this franchise tax is based on the number of shares of stock. So once we get over a certain threshold, every year you're going to need to pay the state of Delaware this tax on March 1st, and it will depend on the number of gross assets and issued shares once we go over the 10,000 share mark. So every year you will need to go ahead and provide Delaware those figures in order to calculate the franchise tax. And at the minimum, the franchise tax is going to be $400 plus a $50 report fee.
And it's really important at the outset of forming a corporation or switching to a corporation that you run through different calculations and scenarios for franchise tax purposes. In my past life as a private practice attorney, I would often see clients who formed their own entities put in certain numbers for the par value and the number of shares, and then they found they were paying an exorbitant franchise tax, particularly with entities with a high book value of assets, such as real estate, but with very little actual liquid assets or cash.
That being said, if a company just has 1,000 to 5,000 shares of stock, the franchise tax in that annual report is only $225, so it is just a flat fee. So if you don't need more than 5,000 shares of stock to start, many do tend to stay below that threshold to not incur any additional fees for the entity. 2 items. The franchise tax must be filed with Delaware to complete the conversion. We're going to go ahead and file a certificate of conversion, more or less officially changes the entity type, and this is also done in conjunction with the certificate of incorporation, more or less creating the actual entity. And then also the franchise tax for the LLC needs to be current.
I also wanted to come back to one point on par value before we go further. It's a concept that's largely outdated except for purposes of the franchise tax. But I would want to note that usually par value is something extremely low. Shares can't be sold for less than the par value. It's often 1/100th or 1,000th of a cent. You can also, in Delaware and some other states, have no assigned par value. Now, I will argue to my dying day, and I've been made fun of quite a bit for this, that having no assigned par value is different than having a 0 par value. I can't find an area where that distinction is important, but I will argue it until I die.
Thank you, Jarrod. So when converting from a Delaware LLC to a Delaware corporation, you're going to need to go ahead and pay the franchise tax for the prior and the current tax year. So that LLC's franchise tax is $300. So this example up here, we have if you convert your LLC to a corporation in 2020, you must pay your $300 tax for 2019. That's traditionally not due until June 1st of 2020. However, that needs to be paid to convert, along with the $300 tax for 2020, which is not due until June 1st of 2021. Now, you might think, okay, let's say we were to do this now. Delaware's not going to prorate that 2021 tax, unfortunately. Once we go into one day into 2020, they're going to want their money in order to go ahead and make that conversion, so it's the full $300. If you've already paid your franchise tax, so for instance, if you've already paid your franchise tax for the 2019 year, it would only be the 2020 franchise tax that would need to be paid in order to convert from this LLC to the corporation.
You know, I think there's one last point for me on converting a Delaware LLC to a Delaware C-Corp, a Delaware corporation. Of course, C-Corp is just a tax status. As I said before, the Delaware LLC is extremely flexible. So in transferring from a Delaware LLC to a Delaware corporation, where there are more rigid rules outside of which you simply can't go, you'll need to reassess a lot of the terms of your operating agreement for the LLC. There are provisions, waivers of fiduciary duty, other terms which simply may not be permitted in the Delaware corporation. You'll need to look through and consult with an attorney to figure out how to reframe some of the deal terms you've reached with the members, founders, and investors.
And one last note on this topic. For instance, the type of company that would be changing from an LLC to a Delaware corporation, what would you say is the situation would you see? Would this be a fast growth type company? Is that what you would usually see, this change being made?
That's right, Brett. And I think, I should have mentioned this earlier when I was talking about the investors coming into a company preferring a C-Corp, a Delaware corporation. If you own an ice cream shop and you're raising just working capital from investors, they're generally probably not going to care, or they may prefer a corporation, but it's not nearly as imperative. If you're a fast growth tech company, for instance, if you anticipate fast growth, trying to disrupt an industry, you're going to draw a lot of attention from professional investors if you have the right idea. And that's the kind of company that really needs to make sure they're a corporation by the time they've left sort of the friends and family round of financing and they've gone to what is referred to as their first round, their Series A round of venture capital financing.
Great explanation. Thank you. So now we're going to go to the flip side, and we're going to go ahead and talk about how to convert a corporation to an LLC. The process is extremely similar. Instead of filing a certificate of incorporation in along with the certificate of conversion, we'll be filing a certificate of formation along with the franchise tax as well. Now, we mentioned some of the reasons why someone would think about going from an LLC to a corporation. Let's switch that around. In your experience, what have you seen from clients when they're looking to make this type of change?
I would say it's less common in my practice, in my 15 years in private practice, to go from a corporation to an LLC. But the reasons you might do it is you simply find that the rules of the corporate form, the bedrock principles that you cannot waive or modify, are simply too restrictive, or that investors are willing to, your friends and family investors, your members in the case of a small business, are willing to take more broad, sort of creatively defined terms. Or let's say the agreement you reach with your founder partner is such that you just can't draft and manifest those terms under corporate law. You certainly can in the context of an LLC. In addition, the LLC receives pass-through taxation. It may find halfway through your first 3 or 4 years of operation, suddenly the pass-through taxation is much more beneficial given the way your business has grown and developed.
So if I'm hearing you correctly, it's more or less the freedom of contract, the ability to customize this LLC to suit the individual entity needs is why you would think that a client would change to the LLC from the C-Corp.
That's right, and that freedom of contract is very attractive. It's one of the main reasons why I forget the precise number, but around 70% of new formations are LLCs. I mean, since that form has come out, it's seen explosive growth. You get partnership taxation, you get freedom of contract to design your own terms, and also no member has unlimited liability. Everyone has limited liability, even the manager of the entity, unlike a limited partnership, for instance.
Very good. Next, we're off to what's known as the S status, nicknamed S-Corp. Who can go ahead and select it? The subchapter S, the AKA S-Corp status, is reserved for small business corporations and refers to only a company's federal taxation. So, for instance, we can't file an S-Corp with the state of Delaware. There simply isn't that type of entity. This is a tax classification on how your corporation or LLC is taxed by the IRS. This tax status is traditionally obtained after the company's formed and then after the tax ID number is obtained as well. An S-Corp doesn't have to pay federal income taxes. Jarrod, do you want to go ahead and discuss the benefits of this S-tax status?
One of the benefits, especially before the LLC came about, is that you could use the corporate form while still receiving similar pass-through taxation that you would get in a partnership or an LLC. Here you're able to take advantage of the corporate form with its interesting provisions, its protections, its fiduciary duties, its guidance in case law and what can and can't be done, and the predictability of operating as a corporation. Now, an S-Corp, there are certain differences between the type of pass-through taxation that it offers versus the pass-through taxation that an LLC offers. And those are very fine distinctions, but they can be important in tax planning and estate planning purposes. So, for instance, in an LLC, income that is gained to the LLC that is taxed as capital gains will be passed through, and the member will also be taxed on that income as capital gains. The character of the income flows through. In an S-Corp, and one of the advantages of the S-Corp, is that distributions from an S-Corp, the nature of the income does not pass through. A corporation is always what's referred to as a blocker. It blocks the character of the income so that the members, when they receive their pass-through distributions, they're considered dividends from the S-Corp, which receive a very favorable tax rate, around 15%.
Okay, so when the shareholders go ahead and receive the distribution, okay.
That's right. And the issue with pass-through taxation is that you'll often have phantom income, which is why there are distributions. When you have to take the income, the gains and losses of an LLC into account, or a S-Corp, you may be taxed on gains in the LLC that you never actually receive as distributions, and that's what's called phantom income. Phantom income is also covered by tax distributions, which are made yearly just to allow members to account for the tax burden of the LLC or the S-Corp.
Now, this sounds great, the taxation. However, there's some limitations as far as who can go ahead and select it. Some of the limitations out there are going to be a vital part of making a decision. So, for instance, what I'm trying to get at here is that non-U.S. clients, for instance, can't be a shareholder, can't be an owner within the company.
That's right, Brett. As you mentioned earlier, this is a tax status that's we had said reserved for small businesses. The S-Corp status, the requirements for S-Corp status fundamentally limit the size and the ability of a company to take in a broad number of shareholders and eventually go public. It simply can't be done with an S-Corp. It's limited to fewer than 100 shareholders. No non-U.S. persons or entities as shareholders. In fact, no entities at all as shareholders. And in S-Corp, every shareholder has to be a natural person, an individual holding shares in their own name.
So that's really going to limit, you mentioned that it can't be other entities. So a shareholder can't be another fund that wants to go ahead and come into this company. So clients that are looking to raise funds or funding in different rounds of fundings, they're going to steer clear of the S status, and they're going to go with the traditional, what they call the C-Corp route.
That's right. And, another point on the S-Corp, and it's a strange point, is that an LLC can actually elect S-Corp status in addition to a corporation. Now, an LLC might do that to get that fine distinction that I mentioned earlier about the character of the income. So an LLC, which has its own pass-through taxation as a partnership, as a default taxation, would elect S-Corp status, and rather than having that character of the income pass through, it would get that S-Corp sort of eccentricity, that the blocker still applies for the character of the income. And again, that's not often important, but it can be for tax planning purposes. A lot of times people hear an LLC electing S-Corp status and think, why would a pass-through entity go through all this and go through, actually subject itself to the limitations of S-Corp status solely to then get pass-through taxation? But as I said, there's a difference there.
So they would like the taxation aspect that you speak of, but then again, we're coming back around to the LLC's flexibility and its freedom of contract, so that keeps bringing people to it. It's not often that we hear from our clients that want to go ahead and file an LLC with the S election. It does come up. We do have information on our sites and blogs. So it's a topic to hit on. A lot of people think, the term S-Corp has got to be a corporation. But no, the S status can go ahead and be obtained for the corporation. It can be obtained for the LLC. So the sky's the limit. Changes can be made. Elections can go ahead and be made, whether it's the S or the C, for both the LLC and the corporation.
I would note, too, you really need to watch the requirements for S-Corp status. If you fall outside of those and they're not cured within a sufficient time, which I don't recall off the top of my head, the timing, you will immediately be taxed as a C corporation at some point. And switching from an S-Corp to a C-Corp without planning for it can have extremely bad consequences, in that a corporation, a C-Corp, is double taxed. It's taxed as an entity, and then the shareholders are taxed on any distributions that are made.
And that's going to segue into the next couple lines here is, how do you go ahead and apply for this subchapter S tax status? The company's form, the tax ID numbers obtained, What we're going to do after that is file the Form 2553 with the IRS to go ahead and make that election for the corporation or for the LLC. We're going to file that 8832 and Form 2553. Often, too, that election may be something that a client is having their accountant assist with. I know clients that we work with that when they're looking to do this election, they're making sure to send that 2553 form in certified, so therefore they know the IRS actually received it when it's mailed in. We're going to go ahead and transition here to how to change a corporation's officers. And this is something that will be an internal matter within the company. We're not going to need to know about it as a registered agent. The state doesn't need to know about each and every change, but it's very important that this is done properly. I know you've had a lot of experience in your private practice time of updating officers.
That's right, Brett. It's very important because you can lead to lawsuits, employment law violations. If you don't terminate an officer correctly, you could cost yourself a great deal of money under an employment agreement in how the options are treated, whether there's accelerated vesting of unvested options, whether the person is cashed out. Often that kind of thing will vary based on whether a termination is for cause, whether cause is found and documented. So let me go through the process here. As Brett said, it's an internal corporate matter. The bylaws generally say how officers are appointed and removed. Generally speaking, however, the board appoints the officers and has the power to remove them. The board can appoint any officers that it finds necessary. There's no requirements that someone have a CEO or a CFO. You do need someone to act as a treasurer or CFO in a financial capacity, and you'll definitely want a secretary, someone to help maintain the files, to sign certain certificates that are required of secretaries. But one person can even hold all these offices if they choose. Now, to effect the removal and replacement of an officer, generally speaking, a board would need to review the bylaws for the required process. They would need to review employment and other agreements with officers. For instance, they'd be looking for sort of just cause provisions. Can the person be fired with or without cause? What are the effects of firing with cause versus without cause? Often those distinctions are made in executive employment agreements. There may be notice periods. There may be all sorts of requirements. The next bullet point here talks about you'll need to review the treatment of vested and unvested options, warrants, and restricted stock that may have been given to that officer. There are agreements that say if they're terminated under various circumstances, how those unvested options, vested options, and restricted stock will be treated. If it's for cause, for instance, many corporate documents will say, or employment agreements, will simply say the person receives zero value for those. If it's for cause, for something moral turpitude, theft, something like that. However, otherwise, there's often accelerated vesting, means the person's options, which technically we're not theirs to exercise at that point, will suddenly all become exercisable into stock, or restricted stock will have to be cashed out, often through a note, a debt obligation that the corporation would issue the employer and would pay out over time. So you need to deal with those other agreements in addition to just the bylaws. Now, unless the bylaws state otherwise, the board would want to adopt a resolution at a meeting of the board, or more often and more easily, you need a unanimous written consent of the directors. A board can act by meeting and resolution, or it can act without a meeting simply by a signed consent by all of the board members. Notably, however, certain actions may require only, say, a majority of the board, but in a resolution and vote. But if you're going for a consent, you need the unanimous written consent of directors. That's a corporate law provision that can't be modified. You'll be documenting it with a resolution or consent. And lastly, if you want to replace that officer, you would need a resolution appointing a new officer and approving of the form of employment and other agreements that that person will enter into with the company, as well as granting that person's signatory and other authority. Now, none of this needs to be filed, as you mentioned. There's no need to file a change in officers. You don't need to file the resolutions or anything. But you will want to make sure, for instance, that if that person is our contact person as registered agent, that you change that name and contact information. So that's something to keep in mind.
Fantastic. So the company is required to file an annual report with the Division of Corporations. These are due by March 1st. It will need to go ahead and list officer and director information. So it doesn't need to be reflecting each and every change. It simply needs to be reflecting the information at that particular time the report's filed. And your registered agent is traditionally sending you notice about the annual report that needs to be filed, and also can help you complete that annual report as well. So now we're on to the next topic in regards to change of a corporation's directors. So this is not pertaining to an LLC, since the LLC doesn't have officers, directors, or shareholders. It's traditionally going to have the members and managers. This is strictly for corporations. So let's go ahead and talk about the steps to go ahead and remove or to replace a director in a corporation.
At the outset, though, in building on your point about LLCs, I will note that many times LLCs will adopt some of the corporate forms in appointing and removing officers. An LLC may still have officers just like a corporation, even though it isn't required to. It's generally managed by a manager. But the officers are the people that actually affect the day-to-day operation of the business. Now, when an LLC takes on those formalities, it can vary them however it wants. It can, for instance, not require unanimous consent of directors when using a written consent. It can simply have the normal board quorum and voting requirements.
Whatever's in the LLC agreement.
That's right. It's completely flexible. However, the same principles apply. So if you're looking at an LLC, look to that slide again if you're removing an officer of an LLC. Now, removing a director is far more regimented by corporate law, because a director is fundamentally responsible for the general oversight of the company. They have a fiduciary duty to oversee the company and to maximize the value of the company to shareholders, a fiduciary duty, which is a very high standard. Now, removing a director can be instigated by the other members of the board or by shareholders. Normally, a director is elected for a term. However, you can provide that a director serves until removed. So the only way to remove a director is by a shareholder approval by no less than the affirmative vote or consent of more than 50% of the shares entitled to vote at that time. So you need at least a majority. 50.00001% of shares have to vote in favor of removal. And that can't be modified. You can't condition that on cause. You can't change the percentage requirement. Directors cannot be allowed to appoint other directors, except in the instance of a vacancy caused by a death or removal or some other unforeseen vacancy on the board. You'd want to consult the bylaws on how to call a shareholder vote, or as with the director's written consent, you can seek a written consent of shareholders. You could approach just those shareholders that represent the majority, and then you simply have to notify the remaining shareholders of the change approved by that majority, either one or more shareholders. Generally, you'd want to adopt a resolution reflecting the removal and approving the tasks that the officers will have to take to implement it. Terminating indemnification agreements, removing the director from any D&O and directors and officers insurance policy, removing access to corporate systems and records and whatnot. Now, the bylaws will address how replacements are selected where a director is taken prior to the expiration of its term, if there is a term. Sometimes shareholders elect the new director, and in some cases, the bylaws can provide that the board can appoint a temporary director until the next election, the end of that director's natural term. Now, again, as with the change in officers, you don't have to file this change with the State of Delaware or your registered agent. It's all done through internal documentation, resolutions, consents, board minutes. And I believe as Brett mentioned, the company's annual report will need to list the names and addresses of the current directors and at least one officer. So while you don't have to file changes, you do need to file a snapshot at a certain point listing the directors and at least one officer.
Fantastic. So we're off to how to change a corporation's shareholders. So the shareholders are more or less the owners of the entity. And this is a very important topic. Mm-hmm. Don't mind going ahead and expand on this.
That's right, Brett. It's an important topic, but it's also very murky. I'm diving in brackish water here because what happens is getting a shareholder out of a corporation, particularly a minority shareholder, is a very touchy subject. It very frequently leads to lawsuits and disputes. Now, I need to make a distinction at the outset between documenting a change in shareholders, such as through sale of shares, something like that, versus trying to remove a shareholder. Now, when you're trying to remove a shareholder, generally that will be documented and governed by your shareholder agreement, which is an agreement among key shareholders to act or not act in a certain way. And it provides penalties, including ways to remove a shareholder or force a cash out of a shareholder. For instance, there's something called drag-along rights, where a majority, if they decide they want to sell a portion of shares or all of the shares and actually merge the company with another entity, they can drag along the minority shareholders to sell their interest at the same price as the majority, whether they want to come along or not. Conversely, there's also a tag-along right, where a majority decides to sell shares, the minority investor can sell a proportionate number of those shares, essentially being able to tag along on the coattails of the majority shareholder sale. So again, the shareholder agreement is where you're going to find how to remove a shareholder generally, perhaps the investor rights agreement, but both of these are not the corporation's documents. These are agreements among the shareholders, and they can provide a wide range of terms. So that's why it's murky. It's difficult to say how to kick out a shareholder because it'll vary. Now, when you're talking about documenting a change in a shareholder, for instance, if a shareholder sells shares to another, say the shareholder complied with whatever restrictions the corporation has on resale in its bylaws, and it also complied with whatever securities law regulations apply to the resale of shares, then properly drafted bylaws and other documents should mean that you don't need to amend corporate documents. You should be able simply to amend the schedule of shareholders, the shareholder ledger, effectively, that's maintained by a corporation. And that should not require any vote of the shareholders. But again, various things can be provided for in these agreements subject to the corporate law boundaries. And so, yeah, as I mentioned, there's the difference between forcing a shareholder out and documenting a change. Now, you may say, what if the change is caused by death? What if a shareholder dies? The general provision there that you'll find in corporate law and in corporate documents is that the person's estate will take on the interest. It may be transferred pursuant to an estate plan, generally not for consideration, not for value, meaning that there's no securities law requirement needed. Usually corporate documents carve out a transfer for estate purposes from any transfer restrictions. So generally when someone dies, it's fairly easy to move their interest to someone else, or the estate itself can stand in the shoes of the dead shareholder for economic purposes, but not for purposes of voting or other powers other than receiving distributions. And the same is true of somebody who receives the shares by estate. As I said, it's easy to transfer shares, but that person will only receive economic value until the corporation admits them as a shareholder officially, which generally just requires the completion of a simple form, a share purchase representation, making certain representations to the company.
Interesting. Now, in regards to any restrictions or transfers and with a corporation, we have our closed corporation, for instance, which is meant for a small, tight-knit group of investors. It does have restrictions on shares of stock, right of first refusal, to help keep those shares of stock within the family itself. Do you mind just talking about that just a little bit?
Sure. Yeah, the closed corporations are a very special type of Delaware corporation governed by specific provisions in the Delaware General Corporation Law that deal solely with closed corporations. And as Brett said, they're meant to be small. I believe the requirement is no more than 30 shareholders. It's a tight-knit, family-owned kind of company. And the restrictions on transfer may be pre-approval of the board. It may be pre-approval of other shareholders. Shareholders will often have a right of first refusal, meaning the shares have to be offered in whole or in part to the other shareholders before they can be sold to a third party. If the other shareholders turn down the right of first refusal, then you can go ahead and sell them to a third party if permitted. And there's other types of restrictions on transfer. Again, without getting into it, because it's a total morass, is getting into the securities law exemptions. Consult an attorney and look to that. Anytime you hear transfer of shares, think about consulting an attorney, because there are federal requirements on the offer and sale of securities and resale of securities.
Thanks, Jarrod. we're going to move on to how to change the number of authorized shares in your corporation. This is a relatively straightforward type filing. We file a stock amendment, and the stock amendment doesn't necessarily need to increase shares. It can also go ahead and decrease the number of authorized shares that the company has to issue. You can remove or add classes of stock. A rare type of stock amendment may be to modify the par value. That's not traditionally done too often, but it could be done. Now, in order to go ahead and make the stock amendment, the companies are traditionally holding an internal company meeting and having any changes approved by holders of a majority of the stock. How is that typically done?
Well, I would note a meeting is certainly a possibility. However, in today's world, getting everyone together in a room or even getting everyone together on a conference call, all the owners of shares, or at least a quorum, usually a majority or perhaps higher, which is required to take action, it's difficult. A lot of times, too, it's very time consuming. There are notice periods that are required by statute. If notice is not properly given, then the shareholder is under no obligation to show up, and the vote really can't go forward. So what you often do is what I said before, where it's shareholder consent. You'll simply go out to the requisite number of shareholders, or all shareholders if you're being particularly democratic, and you'll seek their written consent. They'll sign a consent, and it's as good as a vote without holding a meeting. That's a way you often see this sort of thing done.
Fantastic. So we won't need to know, the state of Delaware won't need to know anything about the votes. There is a certificate of amendment that's prepared and executed by an officer, and that's then submitted to the Delaware Division of Corporations. They'll stamp it, approve it, and have it back in about 3 to 5 business days, and that company now has the new stock structure.
That's right, and it can provide, the different classes of stock can have different rights, different privileges relative to other shares. You'll often see in venture capital investments by professional investors or funds, you'll see certain very specific favorable terms that those investors will demand. A right of future participation in any offers to keep their percentage ownership, as well as a most favored nation, meaning any better terms given to another investor, except in say another round, because that would be covered by the ability to participate, will be given to that shareholder. So they will get the best terms possible.
Fantastic. The next step is, or the next slide, how to change the LLC's members. The process is very straightforward. The members are not filed or on record traditionally with the state of Delaware. They don't need to be filed. They're not provided in the annual report. The LLCs don't have an annual report. It has a flat $300 a year franchise tax. And Delaware doesn't need to know anything about the managers either. So usually the change is just done internally within this operating agreement or the schedule of the members, if you'd like to expand on the change.
Sure. If in the corporate context I was in a swamp, now I'm in the Old West, I'm just shooting from the hip, bullets are flying, jumping on the horse and riding out, because the LLC is even more a creature of contract, as I said. So the terms are very specific to every LLC. Adding or removing members is a very, really anything under an LLC is very company specific. There are no bound requirements or rules subject to law, fiduciary duties, and the good faith obligation that applies to any agreement, including an operating agreement. So again, yes, you're right. It's internal, and it's not filed with the state or a registered agent. Now, if we're talking about removing a manager, I'll just hit on that really quickly. Some LLCs are managed by an external manager.
Who doesn't have any ownership control. They're just simply a manager within the entity itself.
That's right. Oftentimes, the manager role will be referenced in the operating agreement and discussed, but the actual terms of a specific manager's engagement will be provided for in a separate agreement. Now, termination, stripping a manager of its role, or even stripping what's called a managing member, a member who's also a manager, of its role, is again all involved in the terms of the LLC agreement. And in the case of the external manager, that second agreement, which normally says that it will terminate upon termination under the operating agreement. The two happen hand in hand.
So from what I've gathered here and what we've dealt with clients in the past, it's a great idea from the onset of forming an LLC to make sure you think about these contingency situations, the what if, what could happen with the LLC. When we're starting the LLC, everything's going great, but what if things start to break down between the partners? A properly structured LLC agreement is going to spell out what happens if a member wants out of the company, what happens if there's a death involved with one of the members, what happens if there's a disagreement among the members, and how does it get resolved. So it's a great idea to make sure that your agreement's drafted properly.
That's right. I mean, under the definition, there used to be no requirement that you had a written operating agreement, but it was a fool that didn't, because
It could be oral.
that's right. It could be back in the day. However, it's such a terrible idea. If you go into court with two oral understandings of what was said, what was meant, and what was promised, you're guaranteed to get conflicting interpretations. I mean, that's the nature of a dispute. One person thinks they're owed something that the other thinks they do not, or should have a privilege that the other doesn't want to extend. And disagreements without an operating agreement, even though the LLC Act, the Enabling Act for LLCs, does provide certain default rules if an operating agreement isn't in place, those default rules just do not cover every possibility. And they specifically don't cover something like a deadlock in management, except to say you can go to the Chancery Court and effectively have your company dissolved by judicial mandate.
This Chancery Court, you mentioned that. We've not talked about that. That's the court that's specific here to Delaware to help expedite disputes between entities.
That's right. Those are those corporate law experts, the judges who are corporate law or corporate business entity law experts. It's one of the best features of forming in Delaware is you have judges that are experts. They're not handling a basic dispute as their next case. They're not handling a family matter later that week. They only handle business entity cases over and over and over with increasing, complex cases. So the Delaware has essentially built up a roadmap of how to satisfy your fiduciary duties under broad range of circumstances. And because they're drafted by experts, they're internally consistent with exceptions and to an extent, but they're more consistent than you'll find elsewhere. I mean, Delaware simply has a cachet value and a certain amount of respect that you don't get with, say, a Nevada or a Wyoming.
All right. So we're off now to converting a non-Delaware company to a Delaware company. And this is something that we do hear from clients quite often. They may have formed in California. The idea is all of a sudden starting to take off. And lo and behold, they've gone to try to get investors, and the investors are mandating, hey, in order for us to go ahead and invest for this entity, we're going to need to make sure this is a Delaware company first. So we are able to go ahead and assist with making the change from a non-Delaware company to a Delaware company. And why would, per se, a client want to go ahead and become a Delaware corporation when bringing aboard an investor?
Well, as I told you, the investors prefer it, and usually the management prefers being a Delaware company because there's so many management-friendly terms. And I don't mean to imply that it's a zero-sum game where management-friendly means shareholder-unfriendly. But Delaware starts with the business judgment rule, which is a presumption that officers and directors are trying their best and they're exercising their fiduciary duties with due care and loyalty. A shareholder suing these officers or directors has to rebut that presumption before the case can even go forward. So the business judgment rule and other features like that are great protections for management. Really, all the reasons I've mentioned for incorporation apply here. And simply as I said, the respect value that Delaware holds. If you show up with a registered address that's Reno or Las Vegas, people immediately think go-go dancers and Ponzi schemes involving physical gold, hoarding gold, or something like that. It's just not the same cachet value that Delaware has, because shareholders want the predictability, the reliability, and the quality judges and case law that you get in Delaware.
So the conversion process, this again, is 3 to 5 business days. It doesn't take too terribly long. There's going to be a filing of paperwork within the current state which the entity is formed. The next step is filing a certificate of conversion, and the certificate of incorporation with the state of Delaware to go ahead and create the entity, and then convert it from the state where it's originally formed to Delaware. So in Delaware, there's 2 filings that are made that are done more or less at the same time, and that takes 3 to 5 business days.
Now, this is outside of the scope of quite what we're talking about, but it bears mentioning on this topic is that in some states, a switch from a non-Delaware company switching into Delaware from another state will require you to terminate the entity in the existing state and form an entity in Delaware. So effectively, it's the termination and reestablishment of the company. And because that happens by operation of law, it's meant to be very streamlined, but it can create issues. And in fact, you're terminating your former company. You need to make sure your contracts account for that counterparties to your contracts understand that this is merely a termination by operation of changing jurisdictions. So just keep that in mind and pay attention to what the law in your jurisdiction says. In many ways, it's meant as a penalty for going to Delaware. You have to terminate your company there and go through some level of inconvenience because you're leaving us. Very good.
Now, we're going to go ahead and move on to how to convert a we're going to talk about the requirements. I don't really think this takes, we won't spend much time on it. Right there, the requirements needed in order to go ahead and make this change for an LLC. Also, the requirements for the corporation. Really the hardest question coming up with a number of total authorized shares that you would need for a corporation. Now, this is something interesting, making multiple changes simultaneously. So we've talked about making amendments. We've talked about making changes. It's not uncommon for a client to call and need to go ahead and change their name, need to go ahead and file a stock amendment. For instance, I had a gentleman the other day, we weren't his registered agent. He wanted to increase the shares. He didn't like his name. What we did is we went ahead and filed an amendment that we filed one document that went ahead and changed the name of the entity with Delaware, increased the shares of stock, and then also appointed Harbor Business Services as the registered agent. So instead of paying 3 separate amendment fees, we're able to get this done in just one filing. So they're very appreciative of that as well. So a filing service such as ourselves can go ahead and inform you what type of filings can be made all at one time. And it's not uncommon for us to see a client go ahead and change a non-Delaware LLC and then convert into a corporation. So we can make a filing with Delaware to go ahead and change the existing California LLC into a Delaware corporation. So don't be afraid. Give us a call. Send us an email. We'll be glad to go over what can be done or also what can't be done. And this really is important. When making changes, it's a great idea, too, to talk to your attorney or tax professional about these type of ramifications that you might face by making the change, making an entity change from an LLC to a corporation. What are my tax ramifications going to be? So it's a good idea to spell things out and know exactly what you're getting into.
And one last point, we've talked about a lot of filings. Let's say you forget to authorize new shares. You issue too many shares. You had 1 million authorized. You issue 1.1 million.
So you went ahead and, for instance, you only had a million shares to issue, but you accidentally issued 200,000 shares too many?
That's right, and that happens. Delaware has a what they call validation, or what I like to call a cure provision, where you can go back and file a corrective action filing. You have to adopt a resolution of the board, providing details about the issue, whatever wasn't filed or whatever wasn't properly documented with filings in the state. If it requires a vote, you need to take that vote and note it in the resolution. You need to notify shareholders if it's something material, that there was a failure to make the filing. It's a material issue for a company that shareholders need to know about. And then you make the corrective filing. The amendment, you traditionally file a certificate of validation, which describes the defective action or whatever action wasn't taken, and you state, I'm making the filing after the fact. Now, that doesn't necessarily cure issues that come under federal law. It doesn't necessarily prevent shareholders from bringing a lawsuit if there were consequences of not making the filing, but at least for state purposes, you still can maintain good standing.
So this isn't backdating a filing. What this does is this is acknowledging an error that was made and fixing it as of now for something that happened in the past.
That's right. Never backdate a filing.
Delaware won't let you backdate a filing.
The cover-up's worse than the crime, really, and just never backdate.
Well, fantastic.
All right. Well, thank you guys. That was a great presentation and certainly covered a lot of ground there. We do have some time if we want to take some questions from the audience. So if anyone's listening and needs some clarification or has maybe a change that we haven't gotten to, go ahead and type it in and we'll see what we can get you for an answer. While you're doing that, just a quick note on why to choose Harvard Business Services. As some of this we mentioned earlier in the broadcast, but we've been Delaware specialists since 1981. You probably noticed all the information that we covered in this presentation was Delaware specific for the most part. And certainly there are changes you can make to companies in other states, but this really is our specialty and it's what we're great at. So if you're working with a Delaware company, we're a great option for you. It's a family-owned and operated company. We offer free lifetime customer support. We file companies on the same day we receive them whenever we can. We have very low formation prices and a very low $50 per year Delaware registered agent service. And we have excellent customer ratings on Better Business Bureau, Trustpilot, and on Google. We invite you to search for us on any of those and read what people are saying. You might also want to pull up some of our competitors that you might know of and see what they're saying about them. And we're pretty confident that you'll see a good contrast there. If you need to contact us, we're available through a variety of channels. Obviously, phone and email. You can reach us whenever you want to. We have a live chat feature on our website that you can use. We're also available via Skype, via WhatsApp, Facebook Messenger. Whatever platform you are most comfortable using, feel free to go ahead and reach out to us using that. And finally, we do have a blog that we are updating regularly. We have new posts up there once or twice a week, and we will email those out to you on a once-a-week basis. And that is all that we will email you. We don't spam you. We don't sell your information to anyone. We don't send any kind of unwanted content besides what's coming up on our blog. So if you're not subscribed already, those little screen captures there will show you how you can do that, and we'd love to have you be part of our list. And with that being said, we can jump into a couple questions here. Again, if you have any last-minute questions, now's the time to send them in before we end the broadcast for the day. And let's just start with one quick question. If you have a corporation, you're going to file an annual report each year with the information on your franchise tax payment. Is there a way that you can make changes to an annual report that's already been filed?
Oh, most definitely. And we have a lot of clients that need to go this route. They may have made an error as far as a current director of an entity. So Delaware does allow for the amended annual report. It's going to cost $50 to go ahead and get that filed. A service fee, a company such as ourselves will go ahead and offer a small service fee to go ahead and assist and file that amendment with Delaware. But yes, it most definitely can be changed or amended. Now, this isn't necessary at all whatsoever with an LLC. There's no annual report. There's no information to go ahead and update or change. It's just a flat $300 payment.
All right, great. We had one question just come in asking about transfer of interest in an LLC. And I think this is just clarifying an earlier point. If you're changing interest or transferring interest in an LLC, can you just modify the schedule to reflect the change? Is there anything else that you need to do?
Yes, that is a very important point. A properly drafted LLC agreement should not require the vote and other formalities necessary to modify the operating agreement. And again, modification, the amendment, it's all governed by the terms of the operating agreement itself. But usually you'll see a vote required for amendments. You should just be able to modify the schedule without changing the operating agreement and without taking those formalities.
All right, great. And one more question, and I think this is the last one that we have. You spoke earlier about the event of a death for a shareholder in a corporation and kind of transferring to the estate. are there any statutes or anything regarding a director passing away and how that might be replaced?
Generally, a director that passes away is simply treated as if the person resigned. A replacement can be appointed pursuant to the terms of the bylaws, but it's generally just treated as a resignation. Now, you'll need to look to other agreements that director may have had for any terms of fees they might be owed, options they might have, but generally, in terms of just the role as director, yeah, it's treated as a vacancy.
All right. Okay, well, I think that'll wrap it up for us today. So thank you both for your time, and thank everyone for joining us today. You are, of course, welcome to email us or contact us afterwards if there are questions that you didn't think of, and we'd be happy to get them to you. And just as a reminder, this webinar was recorded, so you will receive an email with a link to the recording, as well as a link to the slides that you can download if you want to review those. And we will welcome any questions that you may have. So thanks again for joining us today, and have a great rest of your day.
Take care.